Hey everyone, my name's Andy. My channel's Finding Value. And what we do is we look for value, you scour the entire world looking for value, and we invest in the most undervalued assets in the world. If this sounds like something that's interesting, click the subscribe button. Give me a thumbs up if you like this content. So today we're going to talk about bull markets. And this is about market conditions. We want to find where the bull markets are and invest and go long in those asymmetric bets that are undervalued and starting their bull markets. That's how you get the largest returns over time. So let's jump in here. We've got bull markets. So the quote is, everyone's a genius in a bull market. So I'm going to turn this around and say, if we can identify the market conditions where bull markets occur, everyone gets to be a genius. Heck yes. So really the driver here is demographics is what drives real estate trends, which leads to inflation of the money supply. 97% of all money is created by commercial lending. 50% is residential real estate loans. So the majority of the money comes from residential real estate loans. And when we have, that's where that inflation comes from. Higher prices and more new homes means more inflation. That's why I keep talking about real estate. And you should be interested in real estate if you're an investor. If you are already not interested in it, you need to be interested. Interest rates on bonds move higher under higher rates of inflation. They lag inflation. So really, real estate sets the tone for market conditions. And market conditions sets the pricing of assets in those conditions. So right here is the 10-year yield. We're going to look at some conditions. And what's going on is this has been declining over time, which is absolutely great for stocks. It means that real estate wasn't doing too hot after 2007. It was having problems all the way, and now we're starting to come back up. This is the COVID crash. But in 2016 is when the housing market, the recovery phase, really started to firm up, and you could see interest rates moving higher. We had a problem somewhere, and here we are going lower. This is the COVID market crash. And now we're going to be heading on up, interest rates wise. Next, this is the 10-year, looking at it from a different perspective, zoomed in. We broke to the upside of this pattern, looking like rates are going to go quite a bit higher. Next, this is the dollar. This is a big chart pattern over many years. This is 2000. This is a 20-year pattern. Looks like it could potentially drop to the downside here. This drops out. Look out below. Our commodity investments, our precious metals investments are going to do absolutely killer when this drops out. Now we are seeing, this is the euro dollar. So we are seeing strength of the euro over the dollar. And typically when this breaks out, you get a bull market in commodities and real estate goes higher, which means the dollar's weaker. And we saw that in the early 2000s to 2008 during that commodity bull market. So we're probably going to see a large bull market and inflation come very, very soon. Or if not, it's already occurring. We just have a breakout to confirm it. Next, this is the real estate cycle. So we have peaks in land value cycle, peaks in construction cycle, and peaks in the business cycle. And what I want to point out here is that the peaks in the business cycle are just after the peaks in the construction cycle. So if you look, it's 36, it's a year later. 56 in the construction cycle, 57, 71, 73, 92, 93, 09, this one was delayed some, 25, 29, 72, 73, 78, 80. Notice how it's a couple years after, 2 years after here, 2006, 2008, and that's in the construction cycle. So really what we can do is look at the construction cycle, and this is our leading indicator to tell us when the business cycle is going to peak out. And typically when the business cycle peaks out, that's when your commodities start really heading down. So this is a leading indicator, the housing starts, of when the commodity cycle is going to peak and end. This is also the cycle that we look at, 18, 18, 18, 18, 18, all this. This is an expansion phase, about half of that is about 9 years. And it kind of correlates with the recession and booms of stocks as well. And I just want to go over a couple companies here. This is Apple. It's going up, but This thing's it's right on its trend line here. So I'm going to zoom in here. And what I'm seeing here is it's losing its momentum. This had very good momentum here. You didn't see many down days. It was kind of chugging along. And then boom, it got smacked on the forehead. Big down day, bearish engulfing. Boom, big move down. Come back up, bearish cloud cover. Boom, dark cloud cover. Boom, down, big down days. It's trying to fight its way back up. Bearish engulfing, big down days. Small up days. See these small up days everywhere? Dark cloud cover, boom, down. These guys are all inside of this candlestick. I would say this is going to head lower. This could be a market top. I'm not calling a market top. I'm just saying this stock looks tired. People are selling it here. They are selling. Amazon broke its uptrend. It's trending sideways, and we've got a break of this pattern to the downside. Look at all this. Bearish engulfing, dark cloud cover, bearish engulfing, bearish engulfing, almost bearish engulfing, bearish engulfing here, bearish engulfing. Guys, this is a market top. See how it just hit? And now we've got lower high, lower high, lower high. Now, if this breaks this is a lower low. This could be a top. Facebook. Man, look at it's rolling over. Ooh. Let's zoom in. Is this a shoulder, head, shoulder? And look at all these down days all sprinkled throughout here. Bearish engulfing, bearish engulfing. Look at it here. Doesn't look too bad over here. Dark cloud cover, dark cloud cover. Bearish engulfing. It's slowing down. The momentum's changing. This looks like it's going to head lower, guys. So we'll see if it heads lower. I'm not necessarily calling a top, but it sure looks toppy. So the tech sector looking awfully tired, and rising interest rates are not going to treat them well. This is the same scenario as the dot-com bubble. Remember, we had a commodities boom during that time frame. Interest rates went up, and all of those very high-valued companies had to get valued in a higher interest rate environment. They did not like that, and they crashed 80-90%. These bubble stocks are going to struggle and most likely decline here shortly, is what I'm looking for. Higher interest rates are going to bring down these companies. Commodities are where you want to position because the money in the tech sector is going to rotate into our sector. So inflation is coming from real estate, which will lead to higher interest rates. We are seeing the beginning of it now. Real estate is the driver of inflation, and we can monitor that during monthly updates. Real estate takes years to change. It is very slow to change. All these people who are talking about this large market crash in real estate, I don't think they're right. Number one, none of the metrics are telling us that we have a real estate crash coming. And number two, real estate doesn't move that fast. It's very slow. It may take a year or two of changing days on the market, inventory, interest rates. All of those things have to change for a while before the crash really materializes. I don't think it can just do it in a couple of months. Commodities are a huge winner here with emerging markets. Those are kind of your options, I think. So the conclusion here is you have an opportunity here to look like a genius by investing in commodities bull market. We know how to identify a bull market through real estate cycle. The tech sector is going to be driving into hurricane force headwinds soon. When those interest rates come up, the tech sector is not going to like that. They've been valued for 0% interest rates. When those interest rates go up, and if they lose control of interest rates, if they go to 3, 4, 5%, the tech sector is completely screwed. You're talking 90% decline. So my opinion is we need to position now to profit for these changing market conditions in the favorable sectors. And the favorable sectors based off of ratios, that is the commodity to stock ratio, is showing that commodities have never been this cheap in 100 years. This is going to be a very large commodity boom, and we can get in the beginning of it. Now that's the first phase. The second phase is when you get in these things, I don't want you day trading in and out. Get positions. Get comfortable with the companies that you like. Fill your portfolio with them and sit tight. Buy and hold here. We're going to wait for the valuations, the commodity to stock ratio to get expensive. And when the market conditions change, when the new homes, we'll call it the housing starts, when those start to decline and we see high interest rates, we see all these things in the future, inventory starts growing, days in the market start growing in real estate, our conditions are changing. That's when we want to rotate out of our commodities and go into bonds, because bonds will be paying high interest, and when they crash, they're going to lower rates. The market's going to come down with interest rates. We're going to be holding high yielding bonds. If they can even raise it, if they have hyperinflation before that, it's all game over anyway, and we're in the sectors that we want to be in anyway. But if it still exists, we want to be in bonds. The interest rates will fall, pushing our bonds higher, and when we bottom out, we rotate that into stocks. That's the game. So if you like this content, guys, subscribe to the channel. We'd love to have you in this community. Click the thumbs up button if you like this content. I appreciate you listening. This is Finding Value.